a lot. All right, folks, let's get some initial reaction. I want to bring in now Wellington Alta, their private wealth chief market strategist, Tim Thorne, UBS Wealth Management managing director, Alli McCartney, and of course, QI Research CEO, chief strategist, Danielle DiMartino Booth. We're trying to get a little different today. We usually stand up. All right, I mean, you know.
I want to stand up anyway. I want to stand up and cheer. Goodbye, forward guidance.
Goodbye.
Goodbye, forward guidance. It's become such a distortion in the markets. I'm hoping that when he gets up at the podium, he's like, by the way, there's only 5 speeches from now, like until we release the minutes. I want him to slay Fed communication because it's become just a weapon of its own massive distortion.
Who brought that in? Was that Bernanke who brought that? Who started that whole thing? It just
the Hall of Mirrors.
It just felt like it might have been may have had good intentions, but it just got nuts. Right? Every week I lament, oh my God, 9 Fed speakers this week. You know, the markets didn't know what to do with any of that stuff. You know, but so at least that's one thing on the checklist, Alli.
Yeah, so this is Warsh Watch, you know, that's what we're dealing with. We're trying to figure out if he's a hawk, if he's a dove, if we're even going to know anymore. You know, so this is all about him putting his foot in the sand, which he obviously clearly did, drawing the line in the sand, excuse me. You know, so he's not putting a dot forward. We'll hear about the balance sheet. That'll be interesting. Very interesting to hear the 3.6 number on inflation, but coming down really quickly. So that seems to be a nod to oil and chemical supply chain. And no forecasted rate cut or rise until 2028. So that's very different than where the market is now, expecting a cut, or was 10 minutes ago, 60% expecting a cut. So yeah, this is going to be a very different Fed. And the question is, does it introduce volatility into the market or does it take it away?
So here's the thing, Jim, on inflation. Crude oil is tumbling. I mean, I don't know if anybody at the meeting, maybe they didn't see it yesterday. They were busy. But we were 85. We hit 74 at one point today. You can see the chart there, just absolutely in free fall. The break evens, which is something you've been talking about, they've been tumbling pretty good. Yet still, Citadel put out a warning. They say that there could be a September rate hike. Today, they put this warning out. And again, they're talking about strong wage growth, resilience in demand, supply chain restraints, booming AI investments. It feels like this is the old playbook that I think we hope Warsh moves away from.
Exactly. We're getting from Wall Street, growth is bad. The old Keynesian view that anything that's good for the economy means we have to stomp it down with interest rate hikes. And I think what we're starting to see today in baby steps is the movement away from the Bernanke Fed with the communication strategy, the forward guidance. Look, we should ignore supply side shocks. It's going to work its way through. It's going to be very interesting to see what the month-on-month inflation numbers are going to be in July and August. And we typically, narrative follows price. We could easily have negative CPI prints in those 2 months. So I'm still of the camp that they need to get down to neutral. I think they are going to get down. But I think if we go back and use when Bernanke got in as our reference point, it may take, you know, Warsh a couple of meetings to basically make his fingerprints and his force felt within the Fed.
I want to ask about that because one of the big headlines last time, Danielle, was the dissent. Right, the greatest ascent since 1992. You had easing bias, but you also had, of course, the rate bias with Myron. I mean, how hard is it going to be, Warsh, to be able to convince some of these embedded thinkers? In fact, members of the Fed in the last couple of weeks have given interviews suggesting that they're entrenched with their thinking. They're entrenched with inflation. They're entrenched with, to Jim's point, punishing Main Street for having even a modicum of success.
And that is still where we were still in a higher for longer regime. You know, right now, interest rates are high enough that we've got, according to Bankruptcy Watch, as of the first week of June, we've got bankruptcies up 34% year to date compared to last year at the same time. So small businesses are clearly still suffering, but he didn't get a single dissent today. That means he got his abbreviated, teeny-weeny statement of 4 paragraphs in exchange for no dissents. I think he's done an extraordinary job to have his critics, in terms of what they've been saying publicly, to have his critics stand down and stand with him, despite the fact that he didn't even produce a single dot for himself.
Alli?
I think what'll be interesting is a lot of the things that he wants to look at, or probably even more importantly, not look at. For example, taking the median inflation numbers instead of core headline. These are going to get us down to a place where we actually are looking more at the difference between Wall Street and Main Street and the haves and the have-nots. And as we've talked about a lot on the show, there's a lot of tension there between what's happening to those people who have massive financial asset portfolios and those people trying to feed their families and keep a business going. So I think at some point, I expect him to talk about that a little bit today, if he talks about anything. But this is a complete and total regime change. And I think we're going to see that publicly, and we're going to hear parts of it that are very private as well.
You know, here's the thing, Jim. Today, retail sales came in much better than expected. We've seen the city economic surprise index come in higher and higher. It doesn't mean the data is always great, but it's better than Wall Street's been anticipating. And again, the old playbook says you got to tamp that down. If people make too much money, you've got to tamp that down. And I just, this is why I've always been resentful of the Federal Reserve, the creature from Jekyll Island, because it feels like it's made specifically for Wall Street. What they react to is weak stock markets. You know, Alan Greenspan comes in, he saves a day, sets, in my mind, a blueprint from, you know, this is your job. You come in and you save the day when the market's in turmoil. But what about society? And I'm not talking about society being in turmoil. How about we just get a little bit of success and don't take it from us?
Exactly. And, you know, let's add in the excessive levels of debt in the economy. And as Danielle points out, there is an area of the economy that is very interest rate sensitive that is getting hammered, and the Fed is ignoring that. So you've got specific areas of the economy, and everybody is focusing on the AI, where the credit area, the interest rate sensitive area, is in a recession. So we're going to basically have to have this evolutionary process where we take advantage of growth to grow out of this debt crisis. And if you listen to the Secretary of the Treasury and you listen to Warsh's previous interviews before he became Fed chair, that's the road now. And how long does it take Wall Street to understand that this is the hymnal that they're playing from?
I also think there's another part there which we haven't talked about, which is, you know, Warsh coming in was a Washington appointee, right? He was a friend of the directionality, at least that's what we all thought, of where the administration wanted interest rates to go, which is obviously lower. So the question is going to be, given where we are now, given him trying to get, you know, talking about things like growth and not tamping it down, well, it's one thing not to tamp it down and to stifle it with interest rates going up. It's another thing to decrease interest rates. So we are at this interesting, you know, push and pull, especially because we do have increasingly this bifurcation in the data.
Yeah, I could not agree more. Listening to what some independent mortgage brokers are saying, they're like, refinancings have completely dried up and gone away. You know, homeowners who've got equity in their home that could tap into that and help their monthly budgets get a little bit of relief, they've gone away at these levels. Mm-hmm. And right now we've just seen a dramatic flattening of the curve between the 2-year and the 10-year Treasury. We're down to 33 basis points in between them. There's a real danger that the Fed is about to, and I hate to bring this word up, reinvert the curve. I think it's entirely possible. We've been coming down.
How would they do that?
Well, they would keep up the tough, either the tough talk or the no talk.
Right.
Or just, you know, just keep the markets completely in a state of suspense. They could generate so much uncertainty about monetary policy, and I think that's where Warsh wants to go. That they could flatten it even further. Speaking
of where Warsh wants to go, though, Danielle, this whole thing about how to read or measure inflation, moving away from core PCE to the trim mean. Yep. You know, explain that a little bit to the audience, because, you know, what's the difference? What does it mean? And do you think that's a good idea?
I do think it's a good idea. Right now, core PCE is a broken metric. When we see it rise, you typically go back and see what the stock market did in the previous month, because portfolio investment management fees have such a huge influence on that core PCE figure. Whereas
and they've been through the roof.
Right. And the Dallas Fed, where I was for 9 years, we kind of invented the trim mean. And what that does is it takes a lot of the noise out of it. It doesn't disregard things that we're paying more for, but it takes the outliers out of the equation, things that are causing massive moves, which would, in this case, be something like the stock market, and it tries to find a median. Because right now, if I was to say, Charles, the average amount of savings in the average working man and woman's savings account is X, you would say, no, Danielle, I want the median, because the average is always skewed by those who have a lot more or a lot less. Mm-hmm.
You like that idea, Jim?
Yes, I think if you look at market-based indicators, the 5-year forwards, there's no inflation. If you look at the 2-year break-evens, inflation is dropping. That typically leads. I think we're tired of the Fed anchoring off of flawed data. The 2% target was an arbitrary target that Bernanke decided. It's supposed to be price stability. And so, I think we're in this era where we're going to redefine what the Fed's role is within society, and we're just starting that journey
So
today.
funny, I read an article where the first time 2% was ever mentioned was on an Australian radio show. Some finance minister, someone said, "What's the ideal rate?" And he said 2%. And all of a sudden, it went around the world in a heart. All of a sudden, that was the number, and no one's ever done anything.
Well, because we want to lose all of our purchasing power in the space of 50 years. Who would think that?
Arbitrary. Yeah.
I want to bring up the AI. And the AI revolution, which is driving everything, the stock market, the helping the re-onshoring thing. November 16, 2025, Warsh wrote an op-ed in the Wall Street Journal, "The Federal Reserve's Broken Leadership." And it begins with this: "That's why the U.S. is poised to grow faster than any other major economy. Americans would benefit from higher take-home pay and greater purchasing power if only the Federal Reserve's leadership stopped defending its mistakes and started correcting them." Alli, what do you think about that?
Back to the regime change here, right? But here you have a situation where the Fed is going to figure out what its role is, not only in society, but in the markets. But you also have this secular evolution and revolution, whether you call it akin to the steam engine or internet. Growth, both because of political policy, reshoring, manufacturing. I heard someone recently say, I'll even give him credit, Michael Loeb said, this country has gone from brawn to brains, and now we have both. And so we have all of these driving forces. And so the question is, again, how do we not hold us back, but how, from a societal perspective, do we make sure that there's a little more equality here?
Would that be it? Listen, he's saying AI is disinflationary. And it's going to, I think he believes it's going to be a secret weapon during the war's term, that this is going to be one of his secret weapons to help him to be accommodative to society. What do you think, Jim?
Yes. If you go back to Economics 101, what he's really saying is we're going to shift the supply curve out to generate economic growth. And when you shift the supply curve out, growth goes out and prices go down. We are leaving this era of everybody on the Federal Reserve and Wall Street just focusing on the demand curve. And what AI does, and what Warsh is basically saying, is let's look at the supply curve. Let's look at President Trump's policies that are tax cuts, reshoring. That is supply, not demand. And that's where it gets so frustrating when they go back to the old playbook and say, growth is bad.
Well, they're circling the wagons, though. The status quo, the folks in the status quo. Cato on this said, Kevin Warsh is right about Fed reform, but his inflation solution is a trap, Danielle.
No, I don't believe that his inflation solution is a trap. But Charles, what I would add is, unless we have an act of Congress and get rid of the labor mandate, I'd also like to hear from Warsh about different types of metrics that he's going to follow to better track the job market, rather than the dusty old prone to revision.
He's open to that, though. That's part of his mandate. Right?
It is, Charles, but it's a very difficult road to hoe. Look,
what makes it difficult? The embedded bureaucrats?
Yes.
Yeah.
You just took the words right out of my mouth. He's not made any major changes at the Federal Reserve staff in Washington, D.C., and there will be a lot of pushback if they don't have a 100-year data series that they can seasonally adjust to Kingdom Come. That's how they...
Well, the problem, too, is, he hired a couple of folks, and recently, and then people went in there and said, oh, well, these are, they came from this area, they came from Heritage, automatically the status quo in the financial media, they jump on these things like immediately. They circle the wagons and attack.
And that's a shame. It really, really is a shame, because what part of this country is not moving forward into the latest technologies except for the Fed? Why do they get a free pass for staying in the Stone Ages? They shouldn't.
Let's talk about markets real quick. Jim, and you and Alli are sort of on the same page here, right? Jim's picks, Alli's picks. You both like AI. You both like financials. You like housing and rails, which is interesting.